You mentioned GameStop. You're so last year. What haven't you been trading yellow? Come on.
What is
What's
yellow?
yellow?
I
The
don't even know what
trucking
yellow
company
is.
that was going bankrupt? Haven't you seen what that's done since they look at this? I know we don't talk a lot of stocks, but here it's gone from they're going into reorganization. It was trading 57 cents. It spiked to $5 today. See? What were you thinking? It's not GameStop, it's yellow.
I had put everything into the $4 calls. I didn't check it, so that seemed pretty good. Welcome to the Futures Edge podcast. I'm Jim Urio, and as usual, the co-host and brains behind the operation, Bob Iacchino. We're going to have one of my favorite guests of the month. We have once a month is Mike Arnold, who's the chief technical strategist for Path Trading Partners. He's going to come on a little bit. Bobby and I are going to talk a little fundamentals. I wrote Bobby's Substack today. I'm sure everyone who's watching this has already read it. If you're not, then are we really friends if you didn't read the Substack? But no. My point is, Bobby,
yeah.
Did you like the things I wrote? Should I recap it real quick just to give it
a
thumbnail?
Recap it real quick, but before you do, I'll tell you I liked it. But go ahead.
Okay. So here's the deal, in my opinion. Every rate hike is going to hit differently. For some reason, this rate hike didn't really hit at all. And the question is why? I mean, I think there's two reasons. I think one was the rapidity of rates rising. So someone who held a mortgage, like before you blinked, all of a sudden 3% went to 7%. I think a lot of people are reluctant to get rid of those loans. But here's now what I think the real most important thing is, where we began from and how long we had been there. To put it in perspective, I might get some of these numbers a little bit wrong, but since 1980, the average rate for a 10-year yield in this country was over 5.5%. Now, the 5 years that preceded the first rate hike, the average 10-year yield in that time period was 1.96%. The point I'm trying to make is that in years past, people would have shorter-term loans to take advantage of lower rates. In this particular cycle, everybody had plenty of damn time to lock in duration. So now all of a sudden, everyone's got locked in duration. Everybody has a 30-year fixed mortgage. Everybody has longest car terms that they could possibly get. And all of a sudden, rates went up. Many consumers are insulated to the negative effects of rapid rate hikes. Even small businesses had long-duration loans because of the flatness and the lowness of the yield curve. Bobby, you said you like it, right?
I do. I think that's an excellent point. When you add that to the point that you've made multiple times in the past about the amount of money that the economy had to work through that was given, whether it was pandemic checks or whether it was the reopening of the economy and the surge that came in some businesses there was a lot of money that the economy needed to work through. Now, some people are arguing now that the bulk of the Fed's excessive hikes we're only about 12 to 14 months past that point. And the long and variable lags, as coined by Milton Friedman, people say it's generally about 12 to 18 months. Now, if it's 12 to 18 months, is it strange for it to be 21 months? Is it that shocking? And, people like me who are expecting a recession to have happened already, for us to have hit one already, it doesn't mean that there's no recession coming, which a lot of people are saying, and you're not saying this in the Substack. As a matter of fact, quite the opposite. Yep. You're saying there's likely one coming. Now, I agree with that part of it, and I agree with what you said on rates. And I've said this a couple times before myself. Somewhere in the range of 37, 38% of CFOs in Fortune 500 companies, S&P 500 companies, were not out of high school or college the last time rates were this high for an extended period of time. So they haven't managed their businesses in this kind of an environment. And that's going to be a very big change, hitting to the very same points that you're hitting on in the Substack, I think.
Okay, I appreciate that. And then to put another perspective, something that's in the Substack, is that the percentage, and Cameron, would know these numbers off the top of her head, but there was an inordinate amount of variable rate mortgages, like 3-year ARMs, that needed to, readjust as the rates went higher. Nobody has a 3-year ARM right now. So that's to put kind of a shine of focus on it. Now, there's something else I want to talk about too. Thursday of this week, Japan kind of talked for a second about maybe giving up yield curve control and letting their longer end rates rise. And you saw, I think it was Thursday of last week, the 27th.
Yep.
You saw our rate spike from like 385 to 405 quickly on the news. Big story, little story, no story.
It's a big story, and it's a big story in how it plays out. I've been looking at the Japanese 10-year yield, and from a perspective of what it has looked like, it has broken through not only the 50, but now it's broken through the 60 basis point barrier. Our friend Steph Pomboy, who's very good and very negative a lot of assets right now, put out a tweet today saying, did Japan just burst the bond bubble? And so it'll be interesting to see what new Bank of Japan Governor Ueda does with this situation, because he did talk about being ready to kind of, I'm paraphrasing, but he talked about capping rates at about 1%. Well, that's double where the cap was before. So again, there's all these different scenarios where markets are going to have to adjust to higher rates for longer than maybe they had perceived. Take a look at, we talk about this all the time, everybody who hasn't seen it yet. If you want to know what the market's expecting, you go to the CME Fed Watch tool. By expecting, I mean in terms of Fed rate moves. After the May rate hike, the market started pricing in cuts in July immediately. The highest probabilities for cuts in July. And that slowly bled away. We paused in June. We hiked again. And now the market has gone all the way toward pricing in the highest probability of the first rate cut in May of next year. Last time we talked, it was March. They keep pushing it out farther. Now that could change. But I thought the interesting part about looking at the probabilities tab in the CME Fed Watch tool is you don't get to a point where a cut is almost as likely as no move at all until you get out to March of next year. Prior to that, the number one possibility is no move in terms of probability. The number two is another hike.
Right.
So
That's crazy.
The market's still tentative as to what's going on. This has no bearing on what should happen with equities. We saw equities. We're recording on Tuesday. Equities were down last time I looked, but not down much, right? Nothing that you would talk about as being any sort of crisis. As I look at it right now, we got the NASDAQ down 0.3%. So no big deal. But can risk assets continue to go if your Substack is right and we get a recession, and your Substack is right to the point where there's not going to be enough of a change for the Fed to cut? Right. And I think you're talking about the recession coming, but not yet. So why would they cut is what I've always said.
Yeah. No, that's a good point. And the only reason I would ever say that stocks could keep rallying, again, bullish on the stocks. Was it Thursday or Friday's trade, that big outside day, higher high, lower low? It was Thursday because it was because of Bank of Japan when we hit the lows. I believe we're due for a pullback if we give up those lows from that day for that point in time. But I just talked myself into, I think, what the trade is. I'm going to make a pitch to you and you tell me what you think. I think a steepener. I think if all of a sudden Japan sees inflation, they're going to let their long end rate go higher. Our long end rate might mirror that. And it could actually coincide with the same time we start seeing more recessionary things. We saw the ISM today, again, recording on Tuesday. That SI number was poor. That was not a good number. So all of a sudden, if the numbers start to deteriorate here, we could stop pricing in hikes, start pricing in eases. At the same time, long end rates go higher, mostly because of Japan. I actually think I'm going to put that trade on now that we've talked it out. Thoughts?
Yeah, I like it. I mean, the Dallas Fed index was better. This was the theme for all of today's numbers. And again, you guys are listening. This is a week old right now, what I'm about to talk about. But the Dallas Fed was better than expected, but negative. A lot of the components of the ISM manufacturing PMI were better than expected, but still in contraction, except for employment component, which was lower. So what happens in tomorrow's ADP? It'll already be out by the time anyone's listening to this. What happens in non-farm payrolls? It'll already be out by the time anyone's listening to this. But if you're listening to this now and you didn't go back and listen to the Mike Singleton episode, listen to how he talks about how slowly the employment side of things is going to start to actually hit the real economy. I mean, he's talking about a turtle's pace. And we might start to see some of that stuff based on the ISM figures.
Ultimately, what I've learned in this whole hiking cycle is that nothing happens as fast as I want it to. You and I we are impatient people. And if we believe something's going to happen, we want it to happen yesterday. That's just not the way it works in this economy at all. So I do think the recession's coming. I think the curve is going to steepen, which is, by the way, I argue with this with guys I trade with at my desk all the time too. Technically, a steepening trade now means that the curve will get less inverted, which is actually a flattening of the curve. Do you understand what I'm saying or no?
That's technically correct in my view.
Right.
So it's basically inversely steep right now.
Exactly.
And you're going to watch it flatten and then go back to steep.
The regular shaped steep yield curve.
That's why I got so upset about skip, pause, reversal.
Yeah.
What were we calling it before? We were calling it a pause.
Pivot.
Yeah. It's the same kind of thing. You're being verbally correct.
Verbally correct. Exactly.
Is that etymology? I don't know.
Before we get to Mike, because I want to get your take on the move in oil.
Well, I've gotten many death threats on Twitter, but I got a death threat this past week based on oil prices rising. For some reason, this particular person thinks that I work for the CME and that it's a bunch of Italians boosting crude oil. And he's basically going to come out here and kill me because I'm driving crude oil prices up.
Bummer.
Which honestly,
at it.
No, I'll be dead soon.
Caution, as I showed you on the last episode, now because I ride the L, I'm always armed. Okay.
Well, my home is pretty fortified if anybody were even going to find it anyway. But so I officially put everyone on notice if I don't show up here one of these days because of the death threat that was made to me. Because apparently I'm pushing crude oil prices 21% higher.
I blame you all the time. Yeah.
Yeah, but crude oil's up 21% from the June lows. Something I thought was really interesting today that I read, spending on gas and oil exploration is up. It's expected to be up this year, 50% above 2019 levels. The discoverable barrels equivalent, so what they call the barrel of oil equivalent, so what's in the ground, is down 42% from the first half of 2022 in exploration, dollar for dollar. So they're finding less oil. Now, they're focused on offshore. And this has a lot to do with public policy, right? Because oil companies, drillers specifically, have no idea if they find any shale type of deposits, if they could go ahead and go after them. They don't know. So they're focused on offshore areas where they know they could recover the oil. I've already mentioned this. We are about 37% lower in terms of the number of oil wells that we were operating last time we had this high of production. We're down by 37%. It was over 800. Now it's in the low 500s. That tells you that a lot of the newer wells are producing. And when shale oil wells produce, they produce a high degree of their total production in the beginning, and then they dry up quickly. This is a critical situation for U.S. production. If we don't get the okay to produce more, there's not going to be much.
Well, we can just use what's in the SPR. Oh, wait. They pissed that all away like a bunch of morons that they are. Keep in mind what we're saying here, guys. Energy policy, it would have been easy. They have absolutely fucked it up at every turn. It seems intentional to me. Bob, you agree that it seems intentional?
I do. And the last point about crude oil specifically, Jimmy, what's the easiest way to spur inflation again?
Higher crude oil. Yeah. Energy absolutely.
Price.
Big input costs, right.
So imagine we go into, let's say it's a harsh winter in Europe and there's still a Russia-Ukraine war, and we get continued lowered supplies of crude oil. You're going to have both of them going higher at the same time with no way to relieve it.
Not a good thing. We got Mike Arnold back, by the way. Thank you for joining us, Mike. Can we look at stocks?
We can look at whatever you want.
Whatever I want? That's beautiful.
Yes.
Thank you.
See how it works?
Good. I want the S&P then.
We're still grinding higher. I'm looking at these bigger, longer term, nice little rule that I like to use is when, especially on the higher time frame. We've talked about it before. I use harmonic levels instead of Fibonacci levels, which are just 12.5% increments. Mm-hmm. When we got the close, and we talked about this level multiple times, it's 43.17. I know you'll have remembered that level. And I said, okay, once we get the close above that level, we should continue to see higher prices. Well, I call it the rule of 87.5. We've come really close. We got to 46.30 last week. The rule to complete the 87.5, which is the minimum it should keep going to, is 46.45. So does that mean it has to stop here or there? No. It just means at this point, getting up to these levels, I consider it only adding on very short-term signals to the long side. Otherwise, it's trailing, and depending on the time frame, is trailing on a weekly or a daily basis. Anywhere between that 87.5 and the prior 100 is the next major rollover zone.
Can you tell me what we're talking? What does 87.5 mean again?
That would be the 87.5 percentile from the highs back on January of 22 to the lows of October of 22. I subdivide everything into these 12.5% increments.
Got it. That's okay. I thought it had something to do with the 12.5 because that number
was. It's a retracement, Jimmy.
Yeah.
Right. Okay.
So
wait. So it looks like we're there. No.
Nearly hit it on the S&P. What's interesting, if you look at the NASDAQ, I'm just going to flip over to NASDAQ. We hit that 2 weeks ago. We completed the rule of 87.5 2 weeks ago. And in the Dow, we completed it last week. So out of the three, and the Russell's nowhere near it, by the way. So we're not even going to consider that one. But if you take the S&P, NASDAQ, and Dow, 2 out of 3 have completed it. The S&P's got within 15 points of completing it. And based off of 4,600 index, 15 points is I'm virtually considered it completed, although technically we haven't hit the level.
So that means looking for spots for long are less attractive, correct?
On pullbacks, it would be I would consider them aggressive longs. It doesn't mean they can't be taken, but they have to be managed very, very closely. It's not like you just put on a long and say, all right, maybe I'll put my stop, at 4,000. No, that would be insane. Right. It would be something with tighter stops in case we are forming a more significant topping area. We are getting a series on the daily of push higher on waning momentum. And once I generally see 3 of them, we are getting more and more significantly toppy. But does that mean we have to collapse? No. The 2 things I'm watching for on the daily time frame, this is a horribly sloppy sideways double top, which is lower probability, but I'm using the targets because if we do get a close, we've talked about the rotation zone many times on here. If we do get the close below the rotation zone, which is probably by the time it closes below, they're going to come in about 45.50. If we got a daily close below 45.50, the next pullback level would be 44.92 to 4,500, which is also the prior major breakout zone where we tested in the middle of June. We tested in the beginning of July, and we finally broke out on July 12th. So that would be the first target, and that wouldn't even be doing major technical damage because that would only be returning to the top of the weekly rotation zone, in which case we could see another rotation up. That another rotation up does not necessarily mean we'd have to go to new highs, but that one is the key one I'm talking about. The only thing that does, at this point, major technical damage is if we get a weekly close below 4,300. Other than that, deeper pullback, okay, we could get it, but it does not do major severe technical damage. For the short-term bulls, it would do some pretty decent. I mean, we haven't seen a pullback like that in quite some time, but it wouldn't, from a charting perspective and a technical perspective, would not break. It would not mean I'm going, okay, we're going to 2,000 or something. It would just be, all right, we've had finally the bigger pullback. We have not technically pulled back into the weekly rotation zone since the end of May, which is very unusual to go that much without at least breaking into the weekly rotation zone.
So, Mike, I have a question. You have a channel up here. You have an upward sloping channel.
Mm-hmm.
Do you use that for anything? And here's why I ask. I've had a downward sloping channel on my crude oil contract basically since February of this year. And the only thing I used it for was to line up the upper level of the downward sloping channel. I could point it out when you have crude oil up later, to use it as sort of a confirmation of when a significant event would be happening also outside of the recent channel. Like I didn't sell against the highs, I didn't buy against the lows. Do you use your channel for anything other than a guide?
When it closes in on either a top or a bottom, because the channels aren't, this is also a best fit channel, I will look for something. For example, let's say we did get down to the bottom of the channel area.
Yeah.
It's an area. So let me just draw another line on here. So we see this prior toppy area that we tested in January and then retested in April and May before breaking out. I also see the 50 EMA. Let's say we actually had a multi-week collapse down here. Somewhere in this area, I could start watching for a shorter term. This is a weekly chart, so a daily, possibly bottoming pattern for at least a bounce. So I'm not going to just magically buy, but I'm going to say, okay, we have some things lining up. We also have a prior 50% harmonic from the last major decline in that area. If I flipped around the harmonic slightly higher than that, if I flip these around, and these levels will change if we go on to make a new high, especially this week with Apple and Amazon earnings. But if I come down here and say, okay, you see that's roughly around the 37.5 harmonic. So somewhere in there, if we collapse down here, I'd be looking for some kind of potential short-term bottoming pattern. But again, there's no magic buy. Just because we hit even a harmonic level does not just mean I magically buy or sell. It means I'm looking now closer at an area because that's an area we tend to have a reaction. It doesn't mean a reaction has to happen. I still need some kind of trigger or signal to confirm that, hey, we found at least some short-term support.
So, Bobby, I have a question for you.
Yeah.
Well, actually, there's two questions. First, I'll start with Mike. Those are weekly bars, I assume, right? Not daily. Because the daily bar, something happened on Thursday of last week where after this, Herculean run up from October, we had a higher high, lower low, closed on the lows, have not yet traded below those lows. I know we've talked about this in the past. That doesn't matter to you as much as it does to most people, or do you think it's a strong signal if we break those lows?
That's actually why there's a line on here at 45.53.75. That is the low from last Thursday, which was an outside key reversal day. And That is when, on an outside key reversal day, this one formed the low, but that low is very key. If we see a daily close below that low, which would probably then we'd also close below the rotation zone by the time we got down there, a signal that we could be in to start a bigger pullback than we've seen recently.
Okay, good, because that's what I thought too. Bobby, now the question for you is, in the Substack I wrote, I talked about what I do have on too, because to me it seems like going to go up, going to go down. I'm bullish still, but when options, they're practically giving them away. It seems like a good trade to stay long and hedge yourself to the downside. What I have been doing is selling one S&P option that's about 5% out of the market to buy three that are about 8% of the market. I'm paying money to do that. Selling the one helps it a little bit, but then you have two long options if all of a sudden we break apart. Do you like that trade?
I do. I think people forget the insurance component of options all the time, because now options are viewed as purely a speculative instrument. And I, first of all, think that's very, very wrong. We all pay car insurance every 6 months, every month, once a year, whatever you pay your bill. We pay car insurance, and that car insurance essentially represents this particular conversation with your insurance company. Your insurance company says, I bet you won't get into an accident. You go, I bet you I will. They go, I bet you won't. You go, I bet you I will. How much you want to bet? $500 every 6 months. Done, right? And you pay it and you lose every single 6 months, right?
Yeah.
I look at what you just said there as paying for that kind of a trade as a very, very smart thing to do when you're bullish. And I've said this a million times. Outperformance to the upside is fucking easy. Just over leverage and buy too much GameStop.
Be Kathy Wood, right?
I returned 480% last year. I don't give a shit. How much did you return in that downdraft Mike just showed us that he was retracing from the highs of last year to the lows that we saw in October? How much did you make there? How much did you outperform? Right? Generally, you outperform to the downside, and that's the shitty outperformance.
Right.
So I think that's a very smart thing to do. When insurance is cheap, you should buy some.
So like I said, I have the puts that I'm long are 8% out, but I structured them to October specifically. I'm going to get to a question. Where do you think that's too far on a pullback that I won't get to there? But it doesn't really matter that much. The fact that I have them on October 20th, if we have any significant down move, the skew should pop up and those should rally pretty good. And I'll get out of some of them whether it gets to the strike price or not. But just all things equal, do you think 8% out till October is ridiculously low, or you think it's
No,
possible?
no. Look, 8% is a very reasonable move. We have a 10 to 15% correction multiple times a year, every year.
Yeah, we're
And
supposed
people
to,
forget
right?
that. So 8% is a very easy down move in my view.
Okay, good. Yeah, I like the position. I'm kind of proud of myself. That's why I want to talk about it.
What's generally the worst performing market of the year, or the worst
What do you mean?
performing month?
Oh, October, right? Or is it
No,
September?
September.
Oh, good. Say that's. I didn't even think of that. See, that's how
No.
smart I am. I do smart things even without thinking about it.
Between September and October, I like to generally carry extra protection. I'd rather give up some gains and carry some. It's like making sure all your insurance is in line before hurricane season, not in the middle of a hurricane.
Exactly. I love that. Yeah. All right. Can we move to something else? What do you want to go to, Bobby?
I'd like to go to crude oil, actually, because I want to talk a little bit about this.
And I got to talk, Bob, before we get to crude. You mentioned GameStop. You're so last year. Haven't you been trading yellow? Come on.
What is yellow?
What's yellow?
I don't even know what yellow is.
That was going bankrupt. Haven't you seen what that's done since they look at this? I know we don't talk a lot of stocks, but here it's gone from they're going into reorganization. It was trading 57 cents. It spiked to $5 today. See, what were you thinking? It's not GameStop. It's yellow.
I had put everything into the $4 calls. I didn't check it, so those seemed pretty good, right?
I had somebody reach out to me when Western Alliance was getting killed. I had somebody reach out to me and going, "Do you think it can double from here?" I'm like, "Sure,
sure, quadruple.
It can quadruple,
and it can half."
Right. Should we be buying some? I go, look, your risk is it doubles is your potential reward that you're planning on versus zero, versus it going out of business like two other banks did. If that works for you, go ahead. I'm not doing it. I'd rather put on a bunch of trades that make sense rather than just, should I buy this and try and get it to double? Yeah, sure. Pay off your boat. I don't know what you people are doing. I've never understood that kind of stuff. Okay, if you could, Mike, draw another best fit channel in there from take a look at the weekly for a second. Maybe some weekly. All right.
Hey guys, what are we looking at? Oh, good. Okay, now I recognize the chart. I didn't recognize
that's crude oil.
That short-term. Yeah, I know it now. Yeah.
Yeah. So if you put in that down channel, that's fairly obvious that we broke out of the last few days. That's what I'm talking about there. We had this down channel basically since that double top kind of broke, right? We broke out of it. And I said February, but it's March. So I got the late March, early May. So I got the months a little screwed up. That best fit channel is what I'm talking about. We broke out of it right around when the 50 week started coming into play as well. The weekly rotation zone started crossing and all the like. And this is when I said to myself, okay, if we break out of this channel now and we retest it, which we really didn't, right? I said, we're going to at least make it to what I would consider to be a defining point of the upper trend line of that channel, which Mike can highlight without me even pointing it out because he knows what I'm talking about. But the defining channel is about the week of April there, where you can kind of see his crosshairs. Not really. You do a big swooping move around it, Mike, so your crosshairs show up a little bit better. Do you see where he's pointing to, Jimmy?
Yep, I sure do. Yeah.
So that would be considered to me the defining point of the upper trend line of that trend channel.
Which we haven't gone above it yet.
Right. That would have been my target on this breakout as long as it got out of the way of the weekly rotation zone. And this is why, the person who gave me a death threat, I'm sure he thinks I drove it up here because it's a crude oil based death threat, which is very specific. For me, if we then get up here, break out of it, come back down and test it, that's the kind of thing that I'm talking about in terms of like when I have a channel, I'm not playing this channel at all. Right? I'm not saying, oh, we broke the channel, it's going higher, because it's more of a question for Mike, but you'll have a steep down channel, you'll break out of it, and it'll turn into just a flatter channel. And then a flatter channel, and if you're playing breakouts the whole time, it ends up going back in. Now all of a sudden you're in an up channel, and you lost money like on 4 trades getting there. So that's why I asked that question.
Yeah, and just on a crude basis, here's because I cover crude all the time on the old YouTube channel, but we broke above this is back to the daily. And I still remember this was key. We got the first cross rotation zone. We finally got that close above about 74.50, back on the 11th of July. Came up, smacked into the 200, which is why we watched the 200, pulled back to the rotation zone, rotated up, We also back on right when we smacked into 200, we closed above the 62 and a half. The 62 and a half, let me see this 62 and a half. And this pullback's fine because that did not invalidate the 87 and a half rule. So what was my first area to watch for? A stop raise area was 79.75, which is the prior breakdown zone from when it broke down in April from this little minor top. And then the next target was 81.04. And the final target is right around your defining point, which is 83.25 for me. Then I'm looking at from the highs to the lows. We see here my next target. If we do get a weekly close above 83.25, stop raise target is about 85.90. Next key target is 88.75, and then we're at 92.61. So could we be setting up, especially if we break and get a weekly close above 83.26? We've been in sort of this sideways support resistance channel since it was established, really back in last November. And we're looking to possibly have not broken out of it yet. So that we're approaching that very key level. But I am very focused on that level because if we can get a weekly close above that, we could be shifting into a higher range consolidation at least.
So, Mike, when you look at, because I've been looking at that channel too and those highs that Bobby talked about. So I know that there's a lot that goes into it, but if gun to your head, you have to take a small position right now. Would the small position be short against those levels? And then the much bigger and more aggressive position is if it could settle the weekly close above it?
I'm looking for at least a pause / retracement anywhere in this area.
Right. So the answer to my question then would be yes. It's not enough to make a trade, but if you had to, it looks slightly more likely that those levels could hold for the time being before we smash through them.
Yes, well, generally it's just like what we did with I switched to the daily. So that's a level generally, especially if it takes a run to it. So you see back, if I'm looking at this 200 here, which is this red line, we had a fairly substantial run with only a couple pauses in there. So we were getting overbought. We hit that level, pulled back, softened it once, and then broke through it. We've now gone another run. Look, since we pulled back to rotation zone, and since July 20th, we've only had one down day. So we're getting overbought on a short-term basis. That doesn't mean we have to top and stop, but generally when you've gone on this long a run and we're getting up to a significant area of resistance, I mean, even on the daily, look how many times we had a top here, a top here, a top here. It matters, right? Going to normally break through the first time. I would expect a pullback. I'll be watching the daily rotation zone because a pullback correction can also be more of a sideways, doesn't have to just collapse back down, but it could base somewhere up here between about 50 to 83. And then soften this level a couple times and then smash through it if it's going to smash through it.
Love it.
So when you say that, Jimmy, that reminded me of when you and I were both Futures Now traders on CNBC, right? And one of the things I hated about that role was they'd say, oh, we're talking about crude oil today, bring a trade. And I'd look at a chart like this, right?
And say there's no trade.
Basically, because you're doing a gig, right? It's like gun to your head. What are you going to do? And one of the things they didn't like about me is if somebody had posed that question to me, I'd say gun to my head, I'd buy a pullback. I wouldn't do anything here, right? Yeah. Because if you look at what Mike said about those highs, yes, it's not likely to break those highs the next time up. But if it does, it's going to be violent.
Right. But because that's the point I was trying to make.
And then if you could, Mike, because we're recording this on, what is today, Tuesday the 1st?
Yeah.
This won't be out until next week, Monday. So let's look at a weekly crude and kind of go further out on crude and gold and look more from a weekly perspective as to what you think the targets could be on the up and down.
And I will add that a lot of times people think of technical analysis as just day trader stuff. I mean, a lot of my long-term stuff is based on long-term technical analysis. So
Mhm.
it is a very valuable tool, in my opinion. You guys, I'm sure, would agree.
Yeah, I think it's more valuable than fundamentals in a long term.
No doubt. So what do we got here?
Again, on a long-term basis, after the pullback, after we get if we get a reaction here, that we'll be watching that daily rotation zone. But close above 83.50, minor. Let's see. Let me just zoom in. 86. Next very key level, 88.75. Then 92.60 would be incredibly significant. If it does, if something happens in the world and we go on a more significant bull run, 97 if we do not break this level and close above it on a weekly, the key pullback level I'm watching, if first of all, it's about 80. If we break below 80, it would still just be a normal pullback to the first cross of the rotation zone back to 77. We really start, if we break back below, I'm going to raise this level a bit. If we break back below 75, then the top of the channel is held. I'm going to watch for the potential. Something's really changed with outlook on crude, and I'd watch for a retest of the weekly 200, which we've talked about many times on past podcasts.
I'm
Did
just
you say
noticing that crude finished higher today didn't finish higher, but started the Globex session higher. So the electronic session has a higher finish.
So did you say that the level, give me the level one more time, the first level, 83.20, did you say?
Yeah, 83.25 about.
83.25, 83.25, 83.30. Because that's important, because I am looking to add to crude, because I think the fundamental story is pretty good, as Bobby outlined before.
Yep.
And so I may do that. What should we hit now? Can we hit gold or Bitcoin or something like that?
Yeah, let's hit gold.
Gold, perfect.
I'm still expecting a retest based off some longer term analysis of this 1900 to 1910 level, unless we close on a weekly basis above 2016.1. Other than that, I'm watching for a retest to set up a more significant bottom. If we close back below, and this is the longer term outlook, if we close back below 1900 for some reason, then my target area becomes 1800 to 1812. As long as we hold 1900, then I will still be watching for a more significant bottoming formation to set up, because longer term, I am still very bullish on gold, but shorter term, we should still see at least some kind of pullback again, unless we close above that 2016-10 level.
Bobby,
Yep.
do you think when we're talking about being bullish gold, and we've talked about several different scenarios with the Federal Reserve at the beginning of this, does it depend on a Federal Reserve that is at very least done with hawkishness? Maybe not necessarily pivoting to dovishness, but at the very least done with it.
To a certain degree, I think yes.
I do too.
I look at it this way. Either way, we're at the top of the rate hike cycle. No matter what happens from here, we're at the top of the cycle. If we get two more, right, what's going to be another 50 basis points? Worst case scenario, it's not. It's going to be 50, even if there's two more, right, 25 and 25. So we're at the end either way. So now you mentioned earlier, and I don't know if we were talking on the recording or not, the steepening, which is really a flattening then a re-steepening, as you mentioned. The steepening now matters quite a bit for gold because it's a matter of whether it's a bearish steepener or a bullish steepener, right? And I expect it to be a bearish steepener over time. Now, for those of you that don't know what that means, from a yield perspective, a bearish steepener would be lower yields, but the front end is falling a lot faster than the back end. So
that would be an easing cycle.
Yeah, that'd be an easing cycle. And that would be unbelievable for gold's performance, in my opinion. I could be wrong. Right. And that is what I'm expecting, because that's what you would expect to see if a recession becomes a real thing, which I still think it's going to.
Right, because it would have two things. There would have to be some sort of panic going on for the Fed to be easing, which I believe is quite possible and actually probable within the next year. And rates are going lower. So, it could be a very good thing for gold.
Right. Now, a bullish steepener would mean rates are going higher and the back end is going higher faster than the short end. And that means inflation. And that's not going to be great for gold, because that means the Fed's going to come back in with a vengeance. And that wouldn't be great medium term for gold at all.
What else? Mike, anything else to add, Michael?
Mike, would you agree that gold's been holding in really well from a technical perspective?
Yeah. It's definitely holding in. I mean, if we just look at the long term, if we just do some simple analysis, since it formed the bottoming pattern back in October and then it broke out, you had the first run off, pulled back, and then it broke out in March of this year. It's only really pulled back to that breakout level and held. It could come back and retest that breakout level, but that's why. And you don't get major technical damage done unless you get a close below 1900.
This for both of you. I had somebody call me out because I said at the end of last year that gold was my trade for the year. And I want to clarify something without trying to pretend that I'm right about this. The smart thing would have been the NASDAQ. More specifically, the wonderful seven, or whatever the fuck we call them, would have been the best trade for the year, right? The sweet seven, the silly seven, whatever it was. Magnificent seven. I'm going to call it the silly seven, but it's actually not silly. It's AI is a real thing, but I think people are, kind of blowing out of proportion. As we saw from Microsoft earnings, AI doesn't necessarily mean profits go through the roof tomorrow. But having said that, when you're looking at a trade of the year, to me, again, in referencing what we talked about a few minutes ago about, I don't give a shit if you outperform to the upside. What is the most probable thing to end higher at, from the beginning of 2023 to the end? And it's still gold to me. That hasn't changed at all, because it has the most different scenarios that can happen where the asset still finishes better off. The most likely scenarios, 3 out of 4 of them have gold higher.
Amen. Like I said, I'm long a metric shit ton. Like I said, I just actually got long more physical. This kid who I've mentored, he was like, "Hey, I got a bunch of these maple leafs. You want to take them for spot?" And I did. So yeah. I have guard dogs and guns. Good luck if you come for it and even finding it. But yeah, I have some gold. So be careful. Can we go to copper to finish off?
Copper's still sitting at the prior breakdown level. We've tried to get through it. I thought we were possibly breaking out yesterday, but today, big reversal back into this area. You can see it on the weekly. This was a key support, tested back in June as resistance and tested multiple times in July. Tried to break above it on the daily, which is why a lot of these times I want the weekly close above a level. Not just a daily, because we got the daily and then we got the snapback. That's not to say by the time this week's over, it doesn't finally get the close back above about conservative. You could go to $4. A close above $4 gives you a little leeway in there on a weekly basis. And then the next levels would be 412, and the major level, which has not changed since we talked about this. Wow, last October, I said, in order for me, we had a double bottom that played out. Remember that? And then I said, for me to continue to stay bullish, I needed the weekly close above 432, which we poked above it, closed below it, and that's been the high water mark still. So that level has not changed. That's the only thing that gets me long-term bullish in copper. Until that, if we get that close above that $4, I'm watching for a consolidation pattern to shift higher, unless then we follow through with a weekly close above 412 or 413. And then I'll start more so watching for short-term pullbacks, buy signals on shorter-term pullbacks.
So the fact that we put that wick in today and we rejected those high, on balance, that's somewhat of a negative sign, or on balance, that's neutral?
On balance, if we're going straight from just a technical, we had a breakout and then we got an outside key reversal day. If it wasn't an outside key reversal day, it would not have been as bearish, but that's a pretty bearish sign. If you're going for the bullish case, it might have to regroup a little more to make another run for it, because to wipe out the whole, this engulfed all of the prior days, and then we closed even below the day before the breakout. Just looking at something from a purely technical probability standpoint, that was a very weak day. Does that mean it's going to plummet to new lows? No. That means, you can see here, you can see this nice little trend line with technically the defining point is right there. But could this pull back? and regroup and still make a higher low and then make another run for it? Easily. Would I be rushing out tomorrow and backing up the truck for saying, I got to go buy copper, it's retesting support? Now, if we had just pulled back to like 397, something like that, and had a minor pullback, that would be a normal breakout, possible retest of support. But when you see a bar like this, I got to give it a little more leeway. It's got to show me some renewed strength before I can really go, all right, it's going to keep going. It's going to make that run.
Right. Okay, good. So we're looking at the same way. I actually think that it needs to take out the highs of that red bar, perhaps settle up there to invalidate. Is that reasonable?
Yeah. I mean, that's at this point, I'd want to see it at least. The highest close was from Monday the 31st, pretty much $4. So
right.
I'd be keying off of $4 on a closing basis. So if anything broke intraday, it could be setting off alarms, but there's no way I'd personally carry it unless it closed above $4.
Good.
Mikey,
what else you want to add?
I'm going to throw you a curveball, and I'm going to tell you why while you look at the chart. ITW, which is Illinois Tool Work. I'm neutral bearish on manufacturing in general, right? And then I saw Caterpillar today, right? Mm-hmm. Caterpillar was just through the roof today. Then I see this Illinois Tool Works chart, the daily and the weekly, and I think to myself, okay, Caterpillar is saying that manufacturing's good, or industrials are good in general. Then I look at Illinois, you clearly do Caterpillar quite a bit. Mm-hmm. Then I look at Illinois Tool Works. I don't love the manufacturing sector, but I feel like Illinois Tool Works is giving you an opportunity to pick some stuff up here. If I wanted to buy this, where would you say would be like a safe place? Go through this sort of trade management right now on this particular chart. And I'm not going to hold you to any of it. I'm not doing it. I'm just curious what you think of the chart.
Off the weekly chart,
yeah.
I mean, we set up some highs back at the beginning of January of 22, retested them and softened it up at the end of January 23. Then, as I said, we made a run. This is a sideways base right at resistance. You see 1, 2, 3, 4, 5 weeks. Sideways base, chipping away at a major resistance level. Broke above it. Now we've pulled back to this is a prior resistance becoming support. Historically, this is a potentially bullish setup. The daily is not as fantastic with that gap down, but on a shorter term basis, if it can hold this 250 area, 249, 250, and build a base, or if I had a shorter term buy signal, then as long as we don't really close below 241 and 241, how do I derive that level? Come a little lower, right around here, right there. That's about 240. I give it a little more leeway, but let's just go 242. We're at the bottom of the weekly rotation zone, then that would have broken two key prior resistance becoming support. So this was another minor resistance area you see here. We broke above it, retested the upper resistance, but based between them. So this is the kind of area that, all right, you're on it. I mean, it's a $250 stock. You're risking $8 on a $250 stock, which is on a percentage basis. I mean, somebody could do the quick math for you for that one. That's a tight stop. And so as long as it doesn't get below there, that's how I would set up a trade on any kind of daily bullish setup. Is this a great daily bullish setup the way it closed? At least it closed back above support, but I'd be watching for some kind of base or something to be forming in here, then a rotation back up. And on a tight stop basis, it's a pretty decent low risk reward to at least retest the high areas, and then I could at least trail a stop up, possibly take a little off to pay for the trade, and then if it keeps going, keep trailing. If it doesn't, then worst case is we tried to grab something, it formed, it couldn't get through its prior breakout highs, and possibly turn it into a slight profit to break even trade.
And this is what I like about this particular chart, Jimmy, is that these are all-time highs here, basically, on this. So you're getting a pullback from all-time highs. And so the way that I would look at this is because this daily support held, I'd be looking for it to build a base, because that weekly chart, that down move, It's all today.
Yeah.
Right? It's all today. So we're going to see how the weekly bar ends up. And then next week, Friday, you could be getting an opportunity to get into this particular stock, targeting some of the harmonics to the upside, retracement extensions, or however you would want to play it out.
Right. And who doesn't know what we're talking about here. So this chart, it's beautiful. It comes back down and retests. We love a good retest. Does that mean we buy it there? No.
Yeah.
Guys like us, and you guys correct me if I'm wrong. Now we'll shift to a shorter term chart, perhaps like a 60-minute bar, and look for like a basing pattern and then having it start to move. That's the way you guys would trade it too, right?
Yeah, I mean, I'd be looking at a weekly down to a daily because it's a stock, so it's not necessarily something I want to hold. But if it were futures, yeah.
Yeah.
I'd be going from a daily down to a 4-hour down to a 60-minute.
That's what I would do. Yeah, exactly.
And I just put up, look at, this is why I love some of these tools we put out there, and anybody can do this. You don't have to buy some fancy indicator. These are just the forward harmonic projections of 12.5%. Look, so I'm going to the major low to this swing high from end of January, and I'm doing the 12.5 and 25% projection back up. It broke out. The reason we watch this is because that's the first area could be a key reaction. Look at that. Running right up, coming back down. Now, we break through that. Now I have a next target area. So we take out the highs from this week, from the end of July week, and then my next target area is I
have about 271. Is that where that is?
273.
Okay. There you go.
So that's how I can plan out a trade. Is it guaranteed? No, nothing's guaranteed. But now I can work out, because I'm using some tools where we're at all-time highs. We set an all-time high this week. Well, what's the next logical target? I have to use a tool that gives me a next area that the market's likely to have a reaction near. So now I can work out my reward to risk with key stuff I've talked about. And I can say, all right, we take out the 283 area, which would definitely be a stop raise for me. Then, all right, my next target is 263. Then my next target is the 273.
Cool. All right, you want to leave it there?
That's it. We've covered it.